presentation. Before we begin, just a couple of quick housekeeping items to go over. First of all attendees are in listen-only mode, so there's no need to worry about any background noise on your end. We also encourage questions throughout today's broadcast. In order to do that, simply utilize the questions panel in the GoToWebinar panel on your screen, also noted here with the screenshot on the slide. Finally, we'll have a variety of interactive polls today during today's presentation, and we encourage your participation throughout the presentation in those. So a couple quick other items here to go through. I'd like to take an opportunity to introduce SageWorks. For those on the call who are unfamiliar, SageWorks is a financial information company that provides credit risk management solutions to well over 600 financial institutions across the country. We're also very excited to have with us today Mr. Anson Cooley. Anson is the founder and principal of Synergy Bank Consulting and Synergy Credit Union Consulting. He brings more than 10 years of experience to the industry, and he gained deep firsthand knowledge while serving as a regulatory examiner at the Office of the Comptroller of the Currency. Recently, he has been featured as an expert in Forbes magazine, Independent Banker, and the Credit Union Times. So before I hand it over to Anson, I did want to go through two quick poll questions to get an idea of what kind of institutions we have today with us on the call. So the first question that I'll put up on the screen for the audience to answer is, what is the asset size of your financial institution? So if you could here, go ahead and select the answer that most represents what your institution is, so we can get a feel for, and so Anson can modify his presentation with proper examples for the audience. So take a couple seconds there. It's great participation so far. Everybody is involved with the poll questions early here, so I'll just give it another couple of seconds. Terrific. Thanks everybody for voting. I'm just for purposes of the audience here, I'm going to go ahead and close the poll and share the results. So it looks like the majority of us are between 500 million to 1 billion assets. We also have some that are below 500 million, as well as some between 1 billion and 5 billion in assets, and a couple that are greater than 5 billion. So thanks for your participation in that poll. The last question to kind of tie us in to today's loan review best practices presentation, I'd like to ask how your loan review function is organized within your financial institution. So we've got a few options here that you can select from: in-house exclusively, in-house primarily, outsourced exclusively, outsourced primarily, and certainly there might be other cases. If you'd like to specify that, just type that into the questions box on the GoToWebinar panel so we can get a better idea of other opportunities that are out there. So thanks for your participation so far. I think we'll just give it a couple extra seconds. We have some final answers coming in. All right, thank you for responding to that poll. I'm going to go ahead and display the results as well here. So it looks like the majority of you perform loan review in-house primarily, which means you might have some outside consulting help. We also have a pretty good percentage of you that do it in-house exclusively, and then certainly a percentage that has some form of outsourced loan review function. So I'm going to go ahead and hide those poll results here and go back to my screen. And this time I'd like to go ahead and change the presenter over to Mr. Anson Cooley so that he can take us through today's presentation. So Anson, if you can go ahead and take it away from here and go ahead and show your screen, we'll be all set.
Thanks, Billy. Just wanted to confirm, Billy, can you hear me?
Yes, I can. You're good to go.
Can you hear me fine? Perfect. So what we're going to do here, we're going to do a little bit different today. You'll notice, if you can see my screen, that this isn't your normal PowerPoint presentation here. What we're going to do, we're going to take you on a behind-the-scenes journey of the loan review process. And what you're looking at here is Anytown, USA. And what Anytown, USA is your normal American town with normal small businesses and a diverse economy. And what we're going to do is we're going to walk you through some loan review practices, but through the lens of the process, okay? So we've been tasked to review Anytown Financial Institution. And so this is Anytown's only financial institution, and we've been asked to provide them with a fresh look of their loan review portfolio. Specifically, we've been asked to review their risk ratings, and within the risk ratings, we've been asked to do a deep dive into their special mention category. We've been asked to review the appraisal management process, and also Anytown has recently gotten deeper into C&I lending, so they've asked us to kind of look at some of their new C&I loans, as well as they have a large consumer lending portfolio. So what we're going to talk about is the pre-planning process. We're going to go into the boardroom and look at the in-file review process and kind of discuss some ins and outs about how to do file review properly, okay? So, but one thing that we have really a fun plan today is that we have a game. And so I'm going to use the term substandard. And if you can pay attention, I want you to, at the end of the presentation, click in under the question format and let us know how many times I say the word substandard, okay? The first financial institution to chime in and let us know how many times I say the word substandard will get a $150 gift certificate to have lunch with your group, your loan review group, okay? So let me repeat one more time. Under the question section, at the end of the presentation, when we're taking questions, just type in quickly how many times I say substandard. So let's go ahead and get started. So this is Anytown Bank. As I mentioned, they're a $500 million financial institution. Recently have a new senior lender who's involved, and he's also brought a large C&I portfolio with him. And so we're going to go into, first thing, we're going to go to Synergy headquarters. And at Synergy headquarters, we're going to just take a look inside my office. And so as you can see here, this is my office. Billy mentioned, I worked at the OCC previously as a bank examiner, and one of the things we did as a bank examiner, we had a pre-planning process, and we also did file reviews and exit meetings. So what we're going to do here today is that we're going to go over all the loan review best practices. And I love the analogy around the loan review being an early warning radar for your problem loans, and so that's something that we use all the time. And so here, just wanted to mention to you that when I started at the OCC, we was primarily responsible for Mississippi, Alabama, Georgia, and South Carolina. And while at the regulatory body, I met my wife there, and she's still a regulator now. And we went from Georgia, and then we moved to Illinois. Okay. And one thing that's interesting about us is that I would say that I'm probably one of the only bank consulting, credit union consulting firms that's underneath a regulatory consent order. And you're like, whoa, regulatory consent order? Well, my wife, still being an examiner, she's been giving me a review. And my first review was under my cooking. And so cooking, substandard. Taking out the trash, substandard. And so basically she said there will be no further expansion until the above items are fixed. And so that's just what life like living with an examiner. And then there's this little guy here. This is Anson Cooley Jr. here. And I recently got a call from his teacher, and she asked us where Anson might have gotten exposed to the word substandard before. And I'm like, well, we talk about it. You know, my wife and I, we were bank regulators, we use that. She said, well, every time we bring out the lunch, he just screams out substandard, 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 substandard. So it's just interesting how we're raising little regulators. And that little puppy dog right there, that's our dog Nala. So we're going to go ahead and get started here. And one of the first things we're going to talk about are regulatory expectations. And so specifically, this is from the Comptroller Currency Handbook, where they say internal loan review is a mainstay of internal controls of portfolio. And weaknesses in loan review hamper your entire portfolio management process. And what they mean by that is if you don't have someone reviewing your loan portfolio from an independent perspective, you don't get what you need in terms of real active feedback. Federal Reserve Commercial Bank Examination Manual goes further to say internal loan review should not just be an after-the-fact, loan-by-loan review, but should be a process to detect weaknesses at all levels of your institution's credit initiation, underwriting, and approval system. So that's some of the things that your regulators expect. I've noticed that when you read consent orders sometimes, you notice that regulators may make comments about the loan review process needing to improve. And a lot of that comes through perhaps maybe your regulators having a lot of risk rating changes around risk rating differences between what the bank has and what they have, and loan review not identifying those risk rating changes. So what we're going to talk about now is organizational placement and reporting structures. And this is a common but one of the best practice loan review structures, where the loan review reports up through the audit. And what makes this very important is that by loan review reporting up through audit, it allows loan review to speak truth. It allows loan review to have an objective view of risk ratings. Here's another structure here, primarily for your larger institutions that might have a chief risk officer, whereby the loan review function reports up through the chief risk officer, but also has a dotted line to the board of directors. But one of the more important things, as opposed to just, you have to set the tone from the top down. Specifically, you have to have core policy statements that entrench loan review and say give loan review its independence by policy, not just by culture, but by policy. Another thing you have to do is make sure that your loan review function has the appropriate title. And what I mean by that, I know whether or not you're a credit union or a bank, you want to make sure that the individuals who are tasked to communicate findings have the appropriate footing to speak on an equal footing with the senior lenders or maybe the chief credit officer. So you want to make sure that loan review has the proper institutional stature. Another big point is compensation. Now, if you typically ask senior management, well, how does loan review fit into your risk management structure? You typically hear it's critical. But I remember as an examiner, when we look at the compensation pieces of it, it's not often reflected that way. So how in one way we say that loan reviews are a critical component, but in another way we're not setting up our compensation and our budgets to, one, retain and attract very good talent to be on our loan review team. So compensation is something that's used to speak from top down the importance of the loan review function. In addition to that is access and integration. Getting loan review involved in the watch committee meetings, getting loan review involved in the ALLL, things of that nature, making sure that the loan review process, as it was mentioned before, isn't just a loan file review, but it's shifting from just being loan review, but more getting into being a credit risk management function. So what we're going to do right now, Billy, we're going to go ahead and do a quick another poll here. And the question is, what is the reporting structure of your loan review department? So Billy, would you mind putting the poll up?
Absolutely, Anson. So I've got the poll question up here on the screen. If you could just go ahead and select the option that fits most within your institution. The first option, loan review reports directly to president or senior lender. Loan review reports directly to internal audit officer. Loan review reports directly to either the chief risk officer or chief credit officer, with administrative reporting to board of directors. Certainly other. And then I don't know is an option as well. If you don't mind putting in your response to the questions panel so we can get a better idea where maybe we don't have an option that fits properly here. So it looks like we've got a majority of you voted, so we're just going to give it another couple seconds here before I turn it back over to Anson. All right, thanks everybody that voted. I'm going to go ahead and close the poll and show the results for everybody to see here. So it looks like most of you picked the third option, loan review reports directly to the CRO or the CCO, but also 25% report directly to the president or senior lender. So I'm going to go ahead and hide these results here, Anson, and turn it back over to you for any comments on those results.
Thank you. All right, so just to kind of give you a little color now, it looks like 25% report directly to the president or senior lender. And I'm just going to kind of give you a little feedback on that. When I think about a loan review function being able to speak freely independently, often if it's a large credit that we want to downgrade from maybe pass to substandard, or special mention of substandard, sometimes you get a little pushback, especially if you're dealing with an outsourced loan review function. In that, frankly, just to kind of give you just a little behind the scenes, but not all loan review functions, especially when they're outsourced, it's a business at the end of the day. And you want to make sure, if you're a board of directors or if you're an internal audit, you want to make sure that you're getting the most honest truth, not the truth that gets the person invited back next year. And then also, specifically when the loan review reports directly to the president, you don't always get sometimes the early warning that you may get. I see about 50% report directly to the CRO or the COO, and that from the CRO, that really kind of depends on the chief risk officer. It kind of really depends on how your organization is structured, whether or not the CRO goes up, it's on the audit side or is it on the management side. But with the reporting to the chief credit officer, I'll just give you a point of concern there. If you think about a ring, you have the senior lender, and then you have an outer ring, and you have the chief credit officer. And the chief credit officer is doing the pre-funding analysis and the post-funding analysis, doing the annual reviews and things of that nature, monitoring the tickler reports, perhaps maybe ordering the appraisals and doing the appraisal reviews. If the chief credit officer, the loan review is reporting to the chief credit officer, that's also a potential lack of independence because, again, loan review is going to be evaluating those functions that I just mentioned. Is your appraisal review function operating properly? Are risk ratings being made in a timely manner? Are the annual reviews as robust as what needs to do? So you want to make sure that just for consideration, I think one of the best practices is to have loan review as independent as possible. Because when you think about it, you look at a lot of the banks that and financial institutions that have had problems or failed in the past 4 to 5 years. I promise you, it's not because the individuals within the bank were caught unaware of the problem loans. People were aware of those problem loans. The voice of those problem loans didn't reach the board of directors in a way that they can enact real change. And so that's just a little color around just some best practices. So as we zoom out here, we're going to talk a little bit about specifically going into the bank and some of the things that you do before you go into the bank. So some common request list items. And so what we typically like to ask for is the last 3 reports of exam to give us some color around what the bank's current situation is, the loan policy, list of new originations, the watch list, the problem loan report, as well as the allowance methodology. But here's some additional best practice expanded request list items. The OREO report, and more specifically, your OREO special assets monitoring reports over time. I'm noticing that as we go in, there are a lot of financial institutions that are, for lack of a better word, stagnant. What I mean by that is your classified assets levels aren't going up, but they aren't necessarily going down either. And that can have a lot to do with how efficient and how well run your collections process is being handled, as well as your special assets group. And so that's something that loan review might be able to kind of expand its scope to maybe speak to some of the processes that are happening on the special assets. Because over quarter over quarter, you want to see your classified assets reducing. And if the loan officers are responsible for disposing of credits, or if your special assets group isn't operating under with certain best practices, there might be a lag, or there might be an issue there in terms of reducing your problem assets. Appraisal ordering reports. And actually, just specifically what this is a report that kind of outlines, okay, in the last month, these are appraisals that were ordered for what purpose and by whom. And these reports kind of give you a glimpse of, well, okay, I might compare the appraisal ordering report to my impaired loan listing to see whether or not my impaired loans have updated appraisals. And then also I want to know who's ordering these appraisals and whether or not that process is independent or not. And then just as a function of the review, if you notice that there isn't your institution isn't using an appraisal order and report, that might be a recommendation. Delinquent property tax reports. This is one of the things that I like to ask for, and then compare to like my special mention list, because if you have a loan that's kind of teetering from a debt service coverage ratio, but then you add on top of that they're delinquent on their taxes, that might be something that pushes us over. Okay, so we want to make sure that we're staying on top of our delinquent property tax reports. Loans modified since last review. Now this is when I'm typically going on my TDR hunt. Specifically, a lot of institutions that give you have a TDR listing, but those are the loans that are listed and the loans that have been identified. I'm concerned about the TDRs that maybe not have been identified. And so you might be able to run an ad hoc report, specifically an ad hoc report that identifies loans that have been modified since the last review. And what you do is you take your watch list, or you look at your special mention loans, and you look for loans that may have had some type of large principal concession or some type of the amortization that's been extended, and then you compare it to your watch list. You compare it to your problem loan list and see whether or not it's been identified as a TDR. Another thing you ask for is a stress testing policy in our stress testing reports. And this is something for community banks and for credit unions. This is coming down the line. There hasn't been, for some of the small institutions, there hasn't been a definitive, hey, you have to do this, but we know this is coming down the line as a best practice. There's been some OCC guidance that's come out and some FDIC guidance come out that says it's something that's going to be coming down the line, and that there's going to be a regulatory expectation. So it's something you may want to say, hey, this is something we should start looking toward doing, reviewing our stress testing policy and our stress testing reports. So one of the next things we want to talk about is how are we going about using our sample? So some sampling best practices. Now this is one of the things as far as like coverage is concerned, and this is what you got to watch out for, especially if you're outsourced, is you have your large 10 or 12 loans that everybody looks at, your audit firm looks at, OCC, your regulatory body looks at, and then your loan review looks at. And a lot of times it becomes one of these situations where the sample gets padded, because if you contract with somebody or your policy says that you're supposed to look at 40% of your portfolio, commercial real estate portfolio, or your loan portfolio, and once you knock out those first 10 or 12, you're halfway there, and year over year you're constantly looking at the same loans, but what you're not getting an opportunity to look at is the health of your other portfolio. So although the larger loans are important as a percentage of capital and they pose the largest risk, you want to make sure that we understand what's happening with the entire portfolio. Also, you want to maybe do it by industry, and I mentioned this earlier for us, like C&I. If you're getting into a new industry or a new type of business comes in town, you want to make sure you understand that particular industry. Also, by asset quality indicator, past due, NPAs, non-performing, loans restructured, and by grade. And when by grade, as I mentioned, special mention loans in particular, you want to make sure that the kind of rule of thumb, special mention loans are like a parking lot. Either coming into special mention or you're moving out. But if I can look at a problem watch report and take one from 9 months ago and say John's bowling alley was on there 9 months ago, and here it's 9 months now later, we look at and I see John's bowling alley still on the special mention list. I want to know, okay, what's going on? What's the situation? Because special mention should be used as a transitionary loan grade. Loans typically under the radar. Now this is depending on your asset size. That could, for example, if you're a $5 billion bank, loans typically under your radar could be loans under $1 million. But if you're a $500 million financial institution, loans under your radar could be loans under $500,000. And so, depending on the size, you want to make sure from time to time you're randomly sampling loans that are within loan officer's signature level. Right? So if you're at an institution where the loan officer can sign off and do extensions or do small short-term loans, you want to make sure that you're randomly looking at those to make sure that they're being underwritten properly or that they have the right health with them. So in addition, we have retail loans by product type. So for our credit unions on, you want to make sure that you're not just looking at the 1 to 4 family mortgage portfolio, and also just looking at your car loans, things of that nature. You want to look at your HELOCs. You want to make sure that you're looking at your signature loans, right? You want to make sure you're looking at the credit card, because you want to use your MIS, your past due status, to try to see if there's any trends within that in particular portfolios. Also, commercial and retail loans with multiple extensions. So if you have a report that allows you to look at extensions, again, your loan system has the ability to build these reports. You just got to figure out either through your IT department how to grab the information out of your system to run these ad hoc reports. Another, just from some of the larger institutions on the phone, one of the things is scorecard override. So if at certain institutions, they have a very formatted risk rating system for probability of default and loss given default, things of that nature. But then there's also the ability for certain individuals within the institution to override the grade that the system gives out. Okay, and so one thing I like to do when I'm doing at a large institution, I want to go in and look for those overrides and sample and make sure the reasons that were given for overriding a particular risk rating were accurate, or whether or not they made sense. So that's just some insight on some of the sampling practices. And so this just kind of look at Anytown here. So Anytown, as I mentioned, a $500 million bank, have a loan portfolio about $327 million. They have a large concentration in commercial real estate, 1 to 4 family, but I've noticed here they have an uptick in C&I as well. And so the C&I, and we're going to talk about it when we get to the file review portion, is that for a lot of, if you're a loan reviewer that started within the last, 5 to 6 years, or even a credit analyst that started within the last 5 to 6 years, you cut your teeth on commercial real estate. And you have to understand there's a difference in commercial real estate analysis versus looking at core C&I loans. So we're going to talk about that later. So there are a couple of things that I love to take with me on all reviews. I have them printed out and ready right next. And one of the big things is the Uniform Commercial Real Estate Classification Guidelines. And this allows you to kind of just have right next to you understand how to risk grade and how to grade your consumer and retail loans. Again, this is the Uniform Retail Classification and Account Management Policy. These are the guidelines for your consumer loans. Another thing that I take with me, the Bank Accounting Advisory Series. Now, although this is put out by the OCC, this is a good document to have regardless of whether or not you're a credit union, FDIC, Federal Reserve. They have great Q&A, talk about TDRs, talk about non-accrual situations, and also some good information around the ALLL. Another thing I keep with me now is the Interagency Appraisal and Evaluation Guidelines that came out in 2010, just to make sure that we're on the same page when you're talking with management in terms of the appraisal management processes and making sure everything's independent. Another thing I keep with me is the Prudent Commercial Real Estate Workout Guidelines. I read through it probably about once a month, but one in particular, I have it with me to kind of look in the back. There's an appendix section in this document that has some real good case studies on how the regulators would review certain types of credits. So this is a good document just to kind of have with you to kind of stay abreast on how maybe a loan might be risk rated. I promise you, if you look through that appendix, you'll find some loans that have in their examples that are similar to some situations that you have in your financial institution. Before we go and get into our actual on-site review, I wanted to talk to you just a little bit about why stress testing is important and why we need it. Specifically, there's some common reasons why management kind of doesn't want to stress test, and it's one of the big things is management often says, I hear this sometimes, is our portfolio is very conservative. Our borrowers are paying as agreed, as well as we don't have the time to do it. But if you don't have the time to do it, oftentimes you just get the tip of the iceberg in terms of your portfolio performance, and you don't get the clarity you need to monitor your portfolio properly. So basically what doing stress testing does, it allows you to establish your risk appetite. And this is a term that's been used in the last 2 or 3 years in terms of being able to lean forward in your strategic planning process to identify what type of loans you want to grow, right, within your financial institution. So what you have here is your normal Five Guys burger here, and I love my Five Guys. But what I had to realize is that I can't eat Five Guys 3 times a week because it's going to put stress on my arteries, and it's going to make my cholesterol go up, and things of that nature. And so my wife said, the examiner, right? She's like, hey, I need you to go get a stress test. And I go get a stress test, and what I realized is that, I had high cholesterol. Had I not went and got the stress test, although I felt healthy and I guess I seemingly looked healthy, I wouldn't have been able to see what was going on underneath because I'm eating Five Guys every day. And so if you need to make the case in terms of for stress testing, this is a document that came out April this year. It's called Analysis of the Impact of Commercial Real Estate Concentration Guidance. And what this document is, it's a very well-written white paper that basically looks back to 2008 and looks at the financial institutions that had large concentrations in commercial real estate. And it basically just outlines the degree in which those institutions that had those large concentrations failed over the last 5 years. And so they're able to make a pretty strong argument for why financial institutions should stress test. So again, that's the analysis of the impact of commercial real estate concentration guidelines. Another thing is just to understand what your trouble spots are. So whether or not you're stress testing on a portfolio level, then also stress testing on an individual loan level, stress testing is important to do. As part of your takeaway toolkit that you can get for attending the seminar, well, we provide some example stress testing policy sections to allow you to kind of tomorrow get one foot in the door to kind of move toward developing your own stress testing policy. So all you have to do is just let us know, and we'll get that over to you as a part of the takeaway toolkit. So now we're going to leave Synergy offices, and we're going to go and we're going to visit the bank. So here we are here. Now, this is if you have ever had an opportunity to walk in an examination room or a loan review room, you see a lot of different things kind of laid out. I'm partial to gummy bears, so I always have a cup of coffee and some Haribo gummy bears that I like. But one of the things we're going to kind of just show you real quick is the line sheet that we're using, and some of the things that we have in our line sheet that you may not have in yours, and then also some things that you might want to consider expanding. So here we just kind of have our normal, where we have our overview, kind of zoom in a little bit further here. We have the borrower relationship, SAIC codes. We use some common kind of codes for our outlining the terms, things of that nature. Make sure we have the balance, and we make sure we have what's available on the line. Also, if you look on the top right side, we have whether or not there was a first reviewer or a second reviewer, and the reason why we picked up the credit. We always outline what the primary source of repayment is, as well as the secondary source of repayment. And on the front page, we outline what our collateral sources are, especially when we make sure that we understand any considerations or any concerns we may have had around the appraisal specifically. You also notice that we have a section here for exceptions as well. So I'm pretty sure you have something similar to that. Now, for our comments to support classifications, and I'll say this, a lot of different loan review shops and a lot of whether or not you do it internal and external, some people like to restrict loan reviewers in terms of so they're not as long-winded. I'm of the opinion that I like the document to speak for itself so that we don't have to do as much face-to-face kind of arguing. I want the document to kind of lead the person, the loan officer, to the water that we're trying to bring them to. One of the things I always, just as a best practice, I always write down in the line sheet the questions that we ask the loan officers. This is really important because I want to see whether or not the reviewer is asking the right questions. And this is real good if you're training, right? So you know what type of loan it is, and if you're training, you have somebody that's kind of new to it, you want to see, okay, what were they thinking as they were reviewing this particular credit, and were they asking the right questions? And so it's a tool to kind of track responses, but then also it's a tool to kind of go into and try to understand where your reviewer was thinking about in terms of where their head was. It's good for evaluations and things of that nature. Another thing, section we have is whether or not whether or not covenants were waived, and whether or not the actual financial institution had specific covenants that needed to be adhered to. Okay, and so that's just an outline. Now, I have other examples of loan review sheets that will be in the takeaway toolkit. This will be one. They'll all be clean and redacted, and you can kind of maybe cut and paste and things. One thing that saved us a lot of time is figuring out a way to automate some of the writing in the process by being able to integrate or kind of interface our line sheet with our core system, so we don't have to write the balance, so we don't have to write the borrower's name, so we don't have to write the loan number, and we don't have to start from scratch. And so that allows us to get a lot of efficiency. One of the next big components is loan discussion. Now, see, this is one of the big. This is where it kind of gets into the softer part of being a loan reviewer, whereby you want to make sure that you're always technically sound and making sure that you're asking the right questions. So here are a couple of loan discussion tips. One of the things when we like to start a loan review, I always want to make sure we confirm the understanding of the credit facility. Hey, the purpose of the loan was X, the primary source of repayment is Y, the secondary source of repayment. And one of the ways when we go to have a discussion, if you speak the same way you write it, you kind of go through the same kind of format. And so if you write it out when you're making your conclusions on your credits and you say, hey, well, primary source repayment is weak because of X, Y, Z. Secondary source repayment is strong because of X, Y, Z. Collateral. If you go through the same process, it allows you to have some clarity in your function. Also, one big thing is ask open-ended questions. With the loan officers, you want to make sure, okay, for example, if it's a restaurant, well, Mr. Loan Officer, has there been any significant changes to the restaurant since the last time we reviewed the credit? It's one of those things where if you ask open-ended questions, something might have changed. Well, management might have changed. The restaurant might have burned down. I mean, we've heard of instances of things of that nature. So you want to make sure you ask some open-ended questions as well as specific questions. Anticipate the rebuttal. If you're taking a credit from pass to substandard or from substandard to non-accrual, things of that nature, anticipate what the concerns are going to be from the particular loan officer, from management, and just have those ready. Have those actually, perhaps even maybe have those written in your line sheet, but when you have the discussion, be able to lean into that and have the technical guidance available as well as your talking points ready. So anticipate what the rebuttal will be. After you have a discussion, one of the things you want to do is summarize your conversation in an email. That's just something that I always like to do. You have a discussion, you might be talking, in one day you may have 4 or 5 different conversations about different credits. In addition, you may have 4 or 5 conversations about different credits in a given day. What I always do is I come back to the desk and summarize the conversation in an email just to reiterate what was discussed, and make sure everybody's on the same page. So that's just some best practices there. So one of our next poll question is, who has the final say in loan grading decisions? Is it the loan review officer or director of loan review? Is this the senior loan officer, the committee of a board, the chief credit officer, or the CEO? And so, Billy, I'm turning it on to you so you can give the viewers an opportunity to get involved in this.
Absolutely. So just as Anson just mentioned, everybody on the call, We've got the poll question open now, so if you could just take a couple seconds here and select the answer that is most appropriate for your institution, and we'll move on with the presentation. So just a few seconds here to answer the poll question. All right, we've got the majority of folks have responded to the poll. And just a reminder, a quick reminder, if you do have questions throughout today's presentation, we will save a few minutes hopefully at the end for a couple of questions. So while you're making poll results, if a question pops in your mind here, go ahead and enter it into the questions box. So it looks like we've got mostly everybody in with their response to the presentation, to the poll question here. So I'm going to go ahead and close the poll results and share those results. So it looks like majority said that the committee of the board had the final say, but it's also closely split here between the loan review officer or director of loan review as well as the chief credit officer, and very few people selected senior loan officer. So Anson, I'm going to hide those poll results and turn it back over to you for any commentary on those results.
Okay, definitely. So what we look like here, we have just on the low end, we do have some instances where the senior loan officer is responsible for changing the risk rating. That would, I guess, I would say that does have some issues in terms of like independence, as well as the chief executive officer being responsible as well, because you want to make sure that, again, that risk ratings are accurate, and that affects the timing of risk ratings. Let me just take a step back for a second. When your regulatory examiners come in, they want to trust that when they come in and do a review, that what they're seeing is accurate. And if your examiners come in and they get risk rating differences of like 40% or 50% or even 30% of their sample is different from what you have, it draws concerns about your ability to manage and monitor your own credit risk. And then also it draws concerns about the accuracy of your ALLL as well, because if you don't have loans risk rated properly, then you may not have them properly identified for impairment, which also affects your ALLL. And so you just want to make sure that, just as a best practice, you want to make sure that the loan rating decision is as independent as possible. But then also, even if you want to make sure, I notice here that the largest group is the committee of the board, that the loan review officer, that loan review component, has a voice. So although they make the final decision, you want to make sure that that voice is heard in that committee. Or if you have an outsourced process, you want to make sure that that final report is gets there. Now, one of the things too I've noticed is that sometimes from the first draft to the final draft of the report that gets to the actual board where they're making decisions, sometimes that changes a lot. So you want to make sure that in those discussions that are happening between the loan review function and management, that that's all handled above board and handled in an open discussion format so that we can understand what the reasoning for risk rating particular credits a certain way. So what we're going to talk about here is just some, up here on the, looks like the iPad here, some loan review best practices. So retooling for C&I loans, C&I reviews. Now, as I mentioned earlier, if you cut your teeth doing CRE, a lot of times you kind of used to just, from a cash flow standpoint, you're used to just taking NOI, add back interest and add back depreciation, and voila, you're done. You know, you have your traditional debt service coverage ratio. But when you're looking at C&I loans, you want to make sure that, I mean, it pretty much makes you have to pull out your intermediate accounting book. You know, you have to watch the changes in the payables. You got to look at the cash flow cycle. You have to make sure that you your people are trained in UCA cash flow as well as free cash flow concepts. Okay, and so let me repeat that: UCA and free cash flow. And these particular cash flow methods allow you to get a deeper look into the viability of a business. So if you're talking about, just to give you an example, traditional cash flow doesn't take into account maintenance capital. And what I mean by that is if I own a dredging company, I have my large dredger, right, and I'm depreciating that machine over time, I have to be prepared to fix that machine or replace that machine out of my normal cash flow, right? So you want to make sure that you're accounting for that within your analysis. So one big thing is retool and make sure you have training on UCA cash flow as well as free cash flow concepts. If you see your financial institutions growing in the C&I loan sector. Perform department level reviews. Look at if you have to, find the time in your schedule or outsource that function and say, hey, let's do a deep dive into our special assets and take a look at our collections processes to making sure they're operating efficiently. And also, I know we typically look at appraisals during our file review, but maybe take the time to do a deeper dive into your appraisal management process where you take a larger sample of the appraisals that are being ordered and looking at how the appraisal reviews are being completed. Increase the soft coverage. And what I mean by that is you have your hard coverage where you're looking through the files and you're flipping through them, but then also there's a soft coverage whereby you attend the problem loan meetings and you have a voice on those committees, as well as continuous desktop reviews. If you have a new lender that's bringing in different types of credits that maybe your financial institution isn't used to, maybe the credit analyst may be having a little difficulty maybe monitoring those, maybe although you may have them on an annual schedule to review a complete review, you may want to, if you're getting quarterly financial statements, if you're getting borrowing basis on those particular credits, you may want to kind of and have a continuous look at some of your larger credits. Another best practice is some autopsies of your charge-offs. Take a look back and look at some of your larger charge-offs that you've had over the last 3 to 4 years and kind of look back them from origination all the way to the charge-off to try to identify some weaknesses maybe in your underwriting practices that may need to improve so that going forward and as we grow our loan portfolios, as we go into the next 2014, 2015, we want to make sure that we don't repeat those mistakes. Create process maps. Now, I'm a big proponent of process maps because it allows everybody to be on the same page in terms of what's supposed to happen when. For example, this is a process map that identifies an appraisal review process. And so here you notice the banker orders the engagement letter, sends the engagement letter, the appraiser performs the work, and 3, the appraiser completes the appraisal. Okay. Next thing, the financial institution sends the appraisal for review. The review it's done and then completed. Next thing you know, whether or not you decide whether or not you need to make a change or not, or whether or not the appraisal is acceptable. And so what these process maps allow us to do is making sure that our institutional knowledge and the knowledge around how processes are completed is retained. Because we all know that there are certain, there's individuals that wear multiple hats within our institution. And if something was to happen, whether or not they get another opportunity or they have to be out for a long time, having these process maps allow us to know how to complete these processes in the event that they were, someone said it. And then also, you can hand these things to your regulator and say, hey, this is how our process works. You make sure everybody's on the same page. So in closing, just want to tell you just a little bit more about us. So we're Synergy Bank Consulting as well as Synergy Credit Union Consulting. And we provide credit risk management services, specifically outsourced loan review, supplemental loan reviews, provide periodic deep dive reviews, policy and process developments, for example, stress testing, TDR process developments. Also, we do board and management level training services, and as well as loss share process improvement. Okay, most of our associates are all ex-regulators, and one of our main talking points is that we provide more value for less cost. And in addition, we don't charge our clients for travel expenses ever. And so thank you all for your time and your listening. Please feel free to email me any questions that you may have, and thank you. And so what we're going to do is we're going to want you to, if you have any specific questions, start typing in your questions now. The presentation is over now, so if you want to send over how many times we said substandard during this presentation to try to win your gift certificate, you should do that at this time. Again, my name is Anson Cooley, and the principal of Synergy Bank Consulting, and I'm going to turn it over to Billy to kind of do some additional polling and so we can get to the questions.
Thanks, Anson, and terrific presentation. Really enjoyed the format for today, and hopefully it was beneficial to the audience. I do want to note that we will be following up with an email after today's presentation this afternoon with a link to the recording, so that if either you had some technical difficulties getting in or got in late or would just like to share or watch it again, you'll be receiving a link to the webinar. But to close out, before we get to questions here, I did want to ask two quick final poll questions. The first, we wanted to keep this strictly content-oriented. We didn't want to make this about, too about SageWorks or too much about Synergy Bank Consulting. So we just wanted to launch a quick poll. If you'd be interested in learning more about SageWorks Credit Analysis Solution Analyst, go ahead and indicate your preference here, yes, no, or already a client. This will help us and help you get the information that you need following the presentation. All right, just a couple more seconds. It looks like these votes are flying in, so just a couple extra seconds here. All right, thank you to everybody that voted for today on that poll question there. The last poll question I'd like to ask is, Anson, during the presentation, mentioned a takeaway toolkit that anybody who attended today's presentation will have access to. But if you'd like to go ahead and request that so we know, so Anson knows who to send it to, we're going to have a poll question here to indicate yes or no if you'd like to receive it, just so we can help after the presentation here and get it over to you as soon as possible. So take a minute here and vote if you'd like it or not. Certainly no obligation to do so, and it looks like we already have a majority of responses in here, so just a couple more seconds and we'll get to the poll questions, or the questions for Anson. And while we're on this poll question, Anson, we did have a question that come in that somebody asked, the types of reports and more details of what's going to be included in the toolbox that you're going to send out. So could you give a quick overview of that while we've got the poll question up, in case anybody wants to jump in?
Definitely. It's going to be basically just a Swiss Army knife of toolkits, specifically some additional loan review sheets that you might be able to use. We're going to have the stress testing policy example. I'm going to have an appraisal policy example as well, a TDR worksheet, and also the appraisal review worksheet that we're using for both the consumer side as well as the commercial side. And so that's some of the things, and probably going to just we're very open about providing job aids to clients, things of that nature. So if there's something that you think we may have that that you might need some help with, just ask. But those are some of the items. May probably be more, but just some of the highlights of what will be included.
Thanks, Anson. So if you didn't get a chance to vote yet on the toolkit, go ahead and take an opportunity to do that here. I'll leave it open for another couple seconds. All right, thanks everybody. We're going to pause for just a moment. We've had a couple questions come in. Go ahead if you had any other questions during it while we've got Anson. He's a terrific resource here. If you have any questions about what your institution can do to prepare or to initiate some of these loan review best practices, go ahead and ask a question real quick while we've got Anson on the line. So we'll pause for just a moment.
Billy, can I just have something I wanted to kind of just make a point of, just kind of jump in. I know that as loan reviewers, we run into this situation a lot whereby an exam team may risk grade a particular credit a certain way. Maybe they pass it, for example. Your regulator passes a credit, and then we come and look at it, and we disagree. Maybe we think it's special mention or substandard, and you run into those situations. My recommendation is to go with your gut. I know it's a difficult position to be in, but maybe that you don't know the tenure, the skill level of that person that was reviewing at that point in time. You don't know whether or not they had the exact same information. And oftentimes I've seen where if you don't go with your gut, I mean, I've fallen prey to the pressure around from a management team saying, hey, well, examiners just looked at this and we think it's, they said it's a pass, so how are you going to disagree with them? And then the next year, an examination team comes in and they downgrade it. And we said, well, the last exam team thought, well, they had different information. That was a different examination team, things of that nature. So you just want to make sure that you document your concerns. Maybe you make some transitionary statements within your conclusion, and just always kind of just go with your gut. And regardless of what if you disagree with your regulatory body on a downgrade or not. Okay.
That's terrific. And just a reminder that we will be sending a recording of the presentation out following at some point this afternoon. So be looking for that. If you missed a part or wanted to review a certain part, we'll look forward to having that. And if you certainly have any questions, feel free to contact Anson Cooley at any time. You can see his contact information up there. And you can also, if you have any questions pertaining to SageWorks, you can certainly email me at Billy, B-I-L-L-Y, Burnett, B-U-R-N-E-T, at sageworks.com, and I can certainly help address questions as well or put you in touch with Anson. So I wanted to take the opportunity to thank Anson again for the time this afternoon. We really appreciated the format, and thanks everybody for taking some time out of your afternoon to attend, and we look forward to having you join for a future webinar. Thanks, Anson.
Thank you.